Hi students, in this video we're going to look at the topic of accounting for bad debts. So this is going to be a video that explains the terminology and how we actually record bad debts, a little bit about the methodology and how we accept money if someone comes in later and gives us money after they have been written off. And then later on we're going to look at some numerical examples. Now I know that theory isn't always that interesting. I would encourage you anyway to stay tuned in for the conceptual part of this so that you really understand what's going on with bad debts. If you understand what's going on, it's going to help you later when you have to do the journal entries, and especially on an exam perhaps when you don't have any books to look at and you're trying to think, how does this work? So a bad debt from an accounting perspective is an individual or business that owes us money that we won't be able to collect from. And keep in mind that, accounts receivable specifically are an asset. And they're an asset because we believe that it will provide future value to us. In other words, we'll replace the accounts receivable with cash when they pay us. If it turns out that that business will never pay us, then the accounts receivable is actually not an asset at all. It's worthless if they will never pay us. So at the end of the year, when we go to do our income statement, balance sheet, and so on, every company that extends credit usually has a certain number of bad debts within that account receivable. And what I'm getting at is, let's say our accounts receivable is $100,000 on December 31. We're pretty sure that in that $100,000, there are accounts that will never pay. The thing is, on December 31, we don't know who they are. Maybe we gave them credit on November 15, and they should have paid us by December 15, and they haven't paid us yet, but they might pay us in January. So we don't know yet who won't pay us. But based on our experience, we know that somebody won't pay us. So what we need to do is we need to reduce accounts receivable on our balance sheet to only report the amount of money that we actually think we will collect. So this is an estimate because we have to estimate how much of, let's say, this 100,000 we will never collect. And there are a couple of methods to do that, but we'll get to those in a moment. So to make this estimate, what we do is we have a new account title called Allowance for Doubtful Accounts. Now, allowance for doubtful accounts in accounting is classified as a contra account, and in this case, it is specifically a contra asset. And it's a contra asset because it reduces the balance of an asset. Now keep in mind that accounts receivable have a debit balance. If you want to reduce your accounts receivable, you would reduce your accounts receivable with a credit. So the normal balance of accounts receivable is debit, and the normal balance of allowance for doubtful accounts is a credit. So here's a debit of 100,000 less a credit of 2,000, and this 98,000 would be called accounts receivable net. And that would be the estimate that we believe is collectible on our balance sheet date. And in fact, this is right here a lot like what your balance sheet presentation would be. You would have your cash up here, right there, and then we would have these two accounts showing a net of 98, and then you might go on to notes receivable, inventory, and other assets. So when we sell to someone on account and it turns out they will never pay us, that becomes an expense to us. So there's no sale anymore. Like the sale is there, but you're never going to get your money. So we need to balance that with an expense. And the matching principle says that we will do this in the same period that we made the sale. So that's why we don't just wait and wait and wait until we actually know who won't pay us. And that's because it might be in a different fiscal year. So we want to match the expense of that company not paying us with the same period in which we made the sale. So let's say, we made a sale of, $10,000 to a company, and turns out they didn't pay us. Well, we're going to have part of bad debts expense will probably be that $10,000. Too many zeros. $10,000. And what's going to happen then is that the revenue from the sale is balanced off with the bad debts expense, netting as no net income from that at all. Okay. Now, you might say, why have bad debts? Every company, almost every company, will have some bad debts. Any company that sells on account. And this is because we try to extend credit to credit-worthy customers. If our credit policies are too tight, meaning very restrictive, we may have hardly any bad debts, but we're not selling enough. We're probably turning down too many customers who would pay us. So they're going somewhere else, and someone else is getting that sale. So we can't be too restrictive in our credit granting policies, or we lose sales. On the other hand, if our credit granting policies are too loose, then we have more bad debts than average, and that's a very high cost to our business, and it can cause us to lose a lot of money. So there's kind of a sweet spot for most companies where, yes, if you sell on account, you should have some bad debts, and that tells you that your credit policies are not too restrictive. If someone doesn't pay you, if they went bankrupt or fled the province or something, you're probably never going to get your money. However, if they're around, you can talk to them, and maybe you'll convince them to pay you. Maybe you'll offer to settle for less money, depending how they feel about things. And if they just blatantly say, I won't pay you, and they could, you'll sue them in court. And if you have some security, you might decide to seize the security. So these are some of the things that we could do to try and reduce our bad debts. But that's in the area of collections, which is not really accounting. It's a whole set of procedures all on its own. When we look at accounting for bad debts, there are two different methods, and these methods work quite differently, as you're going to see in our numerical examples. So the first method, and the main method, is based on the balance sheet, and it's called aging the accounts receivable. What we do is we use the accounts receivable accounts themselves and our prior experience to estimate how much we're not going to collect at year end. The second method is the income statement method, and that is called percentage of sales. So the percentage of sales method is exactly what it sounds like. We take net credit sales, so not cash sales because you got your money, so credit sales, and we multiply by a percent, and that percent depends on our previous experience and how many bad debts we do end up having. So keep in mind that both of these numbers give us the number, both of these methods give us the number for our year-end adjusting entry, and in fact, they are both an estimate based on experience. So, if our experience gets better, we can reduce the estimates and vice versa. So before we look at the examples, let's just look at the basic journal entries themselves. So let's say it's December 31, and we've estimated that there is, $2,000 within our 100 that we will never be collecting at all. And that's based on our experience. So we have to debit bad debts expense for that amount. And again, this is the matching principle at work. That bad debts expense, in fact, offsets the sale amount in our revenues. but we don't know who won't pay us. So we can't credit accounts receivable. Instead, we credit this contra asset allowance for doubtful accounts. And that's how we get $100,000 in accounts receivable less a $2,000 contra asset is a net of 98. Okay, so let's say we go along and now it's February 10 and we actually find out who's not going to pay us. So at least one of them, we say, okay, the account of B. Smith is not going to pay. It's been 6 months or 4 months and he's bankrupt and he's never going to pay us. So we have to write off the account. Now, the way you close an account receivable to write it off is with a credit. So if someone had paid you the money, you would credit accounts receivable and their accounts receivable would be gone or closed. So we're going to do the same thing. We're going to close accounts receivable with a credit. So this is, let's say, $500. Now the debit is interesting. The debit comes out of this allowance account that we made. So our accounts receivable is going down and our allowance for doubtful accounts, remember a credit balance in total, is going to be reduced. And that's because we said, hey, we think there's $2,000 that won't be paid. And now we know about 500 of it. So we don't need 2,000 there anymore. We're only going to have 1,500 as a balance. So we're going to take allowance for doubtful accounts. And we're going to debit that. So that means that account is written off. Now keep in mind that this is for our business. This is not the legal system. Legally, these people still owe you money. And if they came into a lot of money and you found out, you would phone them up, excuse me, and you would say, hey, pay me my $500, please. And they would come in and they would pay you. And if they didn't pay you and they had a lot of money, then you would sue them and you would still get your $500. So what's interesting here is after we write that off, if we were to look at the balance of accounts receivable after, if we had, remember we credited accounts receivable for 500, now there's only 99,500 there. But we also debited allowance for doubtful accounts for 500, so there's only 1,500. Notice that the net is still the same. We just reduced both of these, and the difference is still $98,000, which is our net collectible. So that's kind of neat, isn't it? Now, the other thing that can happen, and we always hope, is that someone who we already wrote off before comes into some money and says, hey, I want to clean up these debts that I owe, and they come in and they give us the money. So let's say it's like way later. Let's say it's, maybe October 25, guy wins the lottery, whatever. He says, hey, I'm going to come and pay you that $500 I owe you. So notice that there is no account receivable for this person. So the first thing we need to do, well, we have two entries here. The first entry is to reinstate the accounts receivable. So we don't just see him at the counter and say, okay, great, give me your $500, thank you. And because now I've got a cash debit of $500 and no credit, right? I just have $500 in my hand. So from an accounting perspective, we need to do this with a couple of journal entries. From a front counter perspective, you take us 500, but remember every transaction has a debit and a credit. So we have to do that. So what we're going to do is we're going to reverse this charge off. And the way you reverse a charge off is you debit the credit and you credit the debit. It's just the reverse. So we're going to actually debit accounts receivable. and we're going to credit allowance for doubtful accounts. Now you may charge him some interest. He may owe you $50 interest by now or something, and you could get $550 from him, and you could, debit accounts receivable for the $550, and part of it would be paying off. Sorry, part of it would be the $500 for accounts receivable, and part of it would be interest revenue. But let's just take our $500 for now. Okay, so notice that what this does is it puts back the accounts receivable. So now he technically owes us money on our books because it's an active accounts receivable, and we've put the funds back into allowance for doubtful accounts with a credit. So also on October 25 then, now he's just paying us. So how do you collect from an accounts receivable? Well, you debit cash, and you credit accounts receivable. So it's all fixed. And we have our 500. So notice now that when we collect the cash, we actually have a credit account to put it into. He's paid off his account. And if he ever wants credit later, we'll note that, oh, he had a written off amount, and then he came in and he paid it. And depending on the circumstances, we just possibly might decide to provide credit again one day. Okay, so those are the basic journal entries. And now we're going to look specifically at an example of the two methods. And they're very different. So this is pretty important that you know how these work. I have to get to my second sheet here. Okay, so first, let's look at aging the accounts receivable. It's pretty easy to do. If you had accounting software, you could do this with the press of a button. But I'll explain this to you. If we just made a sale today, it's not due for 30 days perhaps. So the classification of this account would be 0 to 30 in that it's either not yet due or up to the first 30 days, which is really not due yet. Because we give people, let's say, terms net 30, they have to pay us on day 30. So here's the amount of money. So I'm calling this $214,000. And again, this is based on experience. We're saying that 2% of not yet due accounts will end up being uncollectible. So we just multiply here. We go 214,000 times 2% is 4280. Now, they owe us money, haven't paid us, and they're day 31 to 60. So they're either a day overdue up to 30 days overdue. So 31 to 60 isn't good. And lots of these people still pay us. So we're saying that we have $84,000 in the 31 to 60 day age, and that our estimate is 5% of these people will never pay us. Now that may be a bit low, but we'll go with it. So again, 84,000 times 5%, 4,200. Now you can see where this is going. 61 to 90 means they're a couple of months to 3 months overdue. And that's a lot. You know, if you're supposed to pay at day 30 and it's day 80 or 90 and you still haven't paid, that's bad news. So we've got $23,000 there, and we think that 15% of these people will never pay us. So we multiply that, and then our last category is over 90. So it's been outstanding for over 90. And so it's been a long time since for them to not have paid us. So we have $12,000 in that category, and we think 40% of that will never be collected, and we multiply. So our estimate is the sum of these numbers, 16,730. Now I do want to tell you, this is the tricky part. The 16,730 is not your journal entry number at all. Instead, this 16,730 is what you want for the balance of your allowance for doubtful accounts ledger account. So that's going to be the new balance. So we have to say, well, how do I make that happen? So let's say here we have our, I'm just going to call this AFDA. So we have our allowance for doubtful accounts ledger account, and here's the debit column, here's the credit column, and this says the current balance of allowance for doubtful accounts is 800 credit. Now it could be a debit. If you charged off more than you thought you would, it could actually have a debit balance, but in this example it has an 800 credit. So again, the adjusting journal entry under the aging accounts receivable method is not the sum of this estimate. It's not 16,730. Instead, 16,730 is the desired balance. So I want the balance of this to be 16,730. Now, how much of a credit journal entry do I need to turn $800 into 16,730? It's already a credit, so I don't need 16,730. So I mean, obviously, I think it's obvious. This should be pretty easy. We're going to take the 16,730. We're going to subtract the 800 that we already have, and our journal entry is for 15,930. Now this is the normal case, but what if allowance for doubtful accounts had currently a $400 debit balance? So I'm just changing this for a moment. It has a debit balance of 400. So if it has a debit balance of 400, then that's over here. So how do we turn a debit of 400 into a credit of 16,730? Well, we need to make up the 400 plus the 16,730. So we would need the 400 and the 16,730. So we would need a journal entry of 17,130. So I hope you're getting the idea that this 16,730 here needs to be the new balance, not the journal entry number itself. So I am going to go backwards here. I'm going to just go back to the 800. So if we're starting with 800 credit, we only need 15,930 in our journal entry. So our journal entry then, let's make some room here. Just like we did before, our journal entry, December 31, is a debit to bad debts expense. And a credit to allowance for doubtful accounts. I just want to change this so it looks like the right amount. So we have 15,930 as our entry. I'll move this sideways a little bit. Okay, so there's our journal entry under the balance sheet method, also called aging accounts receivable. So you really need to remember that you have to take into account the current balance of allowance for doubtful accounts to get the actual adjusting journal entry number. Now, in this example, I'm saying on March 2, B. Smith was written off for $3,000, and on June 4, a previously written off account for K. Jones was repaid. Now, we went over this in the other spreadsheet page, so hopefully you remember how to do that. So I think what might be a good idea is if you pause the video now and write out those journal entries yourself, the journal entries you need to write off this account of B. Smith and then reinstate and accept cash from the account of K. Jones. So why don't you pause the video and take a minute and do those journal entries on your own and then come back and check. Okay, so let's say you've come back, you've done all your work, you're pretty sure what you need to do. So remember, we're going to take this away from allowance for doubtful accounts. We've already journalized bad debts expense. We don't want to do it again. So it comes out of allowance for doubtful accounts. And remember, allowance for doubtful accounts has a normal credit balance, so that when we debit that, it is reduced. And we have to write off the individual account receivable. So now we've written off the account of B. Smith. It's gone. Now the next part of this was to accept the $2,000 from K. Jones because he was previously written off. Now that was written off somewhere. I didn't show that journal entry, but we can assume it was written off. So now we're going to say, oh, he's coming in and he's going to pay us. Now this account is being repaid June 4. He could have been written off 2 years ago. You know, there's no, well, there is a statute of limitations on debt, but it's nowhere as low as 2 years. So, you know, maybe he came into some money and decided to pay, or maybe we found out he has some money and we said, hey, come and pay us. But he's going to give us the $2,000. So our date is June 4. And remember, this is 2 journal entries. We have to reinstate his account. So we're going to debit accounts receivable to put it back. And we're going to put that amount of money, that $2,000 he's going to repay, back into the credit balance of allowance for doubtful accounts. So this reverses the write-off. Remember, that's what that does. I think I'm missing a space here. Okay. Okay, so that was $2,000. So that's the first part. The second part is to get the money. So he's going to pay us, we debit cash, and we credit accounts receivable. And now we have our money too. Okay, so those are the same entries that we did previously. So the only thing we need to do now is just have a brief look at the percentage of sales method. Now, what makes this method so different is that here we ignore the balance or the existing balance of allowance for doubtful accounts. The number you calculate is simply the number you use for your journal entry. So this is the set of account titles under the same account titles as before, but it's actually a lot easier to calculate. So let's look at that. I have it over here. So let's say that our sales are $3 million. Now these are net credit sales. So not cash sales, and that net credit means sales minus sales returns and allowances and minus sales discounts. So that's 3 million. And I just thought we'd keep the math easy here. Now, our experience says we believe 0.5% of all sales like this will never be repaid. And it has to be a really low percent, because this isn't just accounts receivable that might represent at any given day 10% of your total year sales or something close to that. This is all your sales for the year. So it's quite often that you see a low number here, like 1%. Now, I've used 0.5% just to show you that it could be less than 1%. So, don't worry if it says 0.5% or something, or 0.7%. That's still okay. So we just need to multiply it. So I've taken 0.5% times 3 million, and I get $15,000. So this is not the main method because we consider it not as accurate as aging the accounts receivable. However, it sure is easy because as an accounting student, at least, you're given the 3 million, you're given the 0.5%. All you need to do is multiply those two numbers, get 15,000, and plug it into your journal entry. So there's my 15,000. And that's our adjusting journal entry for bad debts expense under the percentage of sales method. So pretty neat, right? Okay, so we've looked at both methods, and we've looked at how to calculate the estimate for the December 31 journal entry, and we've looked at charging off an account, and we've looked at reinstating an account and collecting the balance from a previously written off account. So any homework or any test question you have on this topic is probably going to be very similar to this, because really at this stage in your accounting career, this is all that you need to know about accounting for bad debts. So see you next time.